Hey, this is Jeff from MidStreet, back with another video in the Small Business Valuation Essentials training course. In this video, we're going to talk about the buyer test method and how you can use it to sanity check your valuation. So we're at the end of the valuation process where you've already come up with a value and now you're trying to test it to see, is it realistic? Is it something that a buyer would actually pay? So like a lot of math problems, you can use this to start from the end and work back to the beginning and test out your assumptions. The buyer test method works specifically for SBA 7A deals, so that would be a business under about $6 million in purchase price. And there are some pretty strict rules outlined in what are known as the SOPs, the SBA 7A Standard Operating Procedures, and we'll reference those to give you kind of a basic overview. So for those who aren't familiar, the SBA 7A loan program is a government-backed loan program that helps incentivize banks to issue loans to individuals looking to acquire small businesses. So basically the government provides incentives in the way of paying if somebody defaults to make it make sense for these banks to issue the loans. So traditionally, the banks have to charge such a high interest rate because one loan defaulting, where it's a $4 or $5 million loan, would be a pretty big hit. So the way the loan program works is every borrower pays what's known as a guarantee fee, and that goes into a big pot. And then if one of the loans defaults, that money is used to pay back the lender. And the lender can be paid back up to the guaranteed portion amount, which is usually set at about 75% of the total loan, of the total purchase price. And when you factor in the equity injection and other assets that can be collateralized, you end up fully collateralizing the loan between those different sources. So the SBA 7A loan program is self-funded. A lot of people talk about this as a drawback. You'll find some investors talk about these fees as being super high, and they are pretty high, but they're what allow this program to exist. So here are some of the basic rules of the 7A loan program. So right now, this is 2022. The current loan amount is set to $5 million. The maximum interest rate that can be charged is the Wall Street Journal prime rate plus 2.75%. For a SBA 7A loan where there's only the business involved, then it's a 10-year term. When you get the real estate involved, it can be up to 25 years. It becomes a weighted average of the two, and then once you get above 50%, it converts to straight 25 years. There's the fee that we just mentioned called the guarantee fee, which has a defined calculation that we won't get into, but you can read in the SBA SOPs to find out how to calculate a guarantee fee. There's working capital included in our calculations because most lenders will include this in the loan. This would be money to hold you over while you start to build up your AR and build up your inventory and things over the first couple months owning the business. The down payment can be as low as 10% in a full change of ownership where some outside individual like an arm's length transaction is buying the business. But we tend to use 15% here at MidStreet just because we found that's more realistic for most borrowers. And the business's cash flow has to support a debt service coverage ratio of 1.25 times, but there's a specific way to calculate it that we'll get into. So here's what the buyer test method looks like. And you can see we have two scenarios. In our valuation, this would be the low price scenario, and this would be the high price scenario. So this is the range of value that we established. And then we show here the range of debt service coverage ratio that this business meets across the value. So going down the list, just to talk about some of these items, we have the purchase price. So that's the entire purchase price of the business, not just like the amount allocated to goodwill or something. This is the full value. There's the value of the real estate, which in this case there is none. Any owner financing, in this case we chose to do $600,000 for the purposes of the valuation. Any working capital that you anticipate the borrower to get from a lender, and this is just to make sure that you don't exceed the loan request, and that'll be factored into the debt service. Then the down payment of 15%. We typically see lenders vary between 10 and 15%, but 15% is a good level to set it at for the purposes of making sure it meets the requirements. And then you'll see what that fee is. And this includes other closing costs that we've baked in to make sure it's realistic. Then the project cost is calculated from that. That's the sum of all the money changing hands. From there, we can figure out what the loan request is, and this is the amount that cannot exceed $5 million. And then we have the term, because there's no real estate involved, it's a straight 10-year term. And then the maximum interest rate, again, is the Wall Street Journal prime rate plus 2.75%. And then we can calculate the monthly debt service. And so when calculating the debt service coverage ratio, you start with the seller's discretionary earnings for the most recent full year. And then if the buyer is purchasing the real estate as well, you'll add back in the rent that the seller was charging themselves. And you'll subtract out a fair market salary for the borrower. Usually this would be around $100,000. I would say a good rule of thumb is not to go below $75,000 unless the spouse of the borrower has a job and you can kind of substantiate that their bills would be paid by that and get away with a little bit less here. And so that leaves you with a amount available, or SDE, after paying those things of $1.3 million. So when you divide $1.3 million by the annual debt service, or the $45,000 times 12, you end up with a debt service coverage ratio of 2.4. This is a pretty big 7A loan, right there near the top of what's allowable. And so because of that, these numbers are going to be pretty high. It tends to be that as the 7A deals get larger, you get a little bit more headroom for the debt service coverage ratio. And on small deals like the 200, 300, 400,000 in cash flow deals, you're typically going to end up pretty close to 1.25 to 1.5. But for a deal this big, anything over 1.75 is probably acceptable from a pricing standpoint. You could get it done on thinner, but most buyers are going to look for a little bit more margin when it's a bigger loan. And then here's a second look at that same information displayed a little bit different. This is from an older format of our valuation at MidStreet. So it gives you just a little bit of a little different perspective on how you could possibly lay it out. So the buyer test method is a really great way to double check when you're valuing a 7A business that you haven't overvalued it if you're anticipating a buyer to use the 7A loan program. So if you want to learn more, you can download our sample buyer test method sheet, and that's available on the Fair Market Business Valuation blog we put together. So if you go to Google and you search MidStreet Fair Market Valuation, you'll see this blog here, and it has a download in it. So I can open this real quick and show you. You'll fill out your information here, and then that'll download a sample for you to check out. So hope you found this video useful. If you have any questions, feel free to leave them below or shoot me an email, jeffjr@midstreet.com. Thanks again for watching, and I look forward to seeing you in the next video.